Okay, good morning, everyone, and welcome to our first of 3 results webinars we have between this week and next week. You're all very welcome. My name is Mark Tobin for anybody who is joining us for the first time. And I'm just going to quickly run through some intro slides here, and then we're going to get straight into it with our first presenter. I'm the founder of Coffee Microcaps, and you're very welcome to anybody joining us for the first time and any of our regular attendees. First off, I'd like to give a shout out to RAS Research and Service, our sponsor for all our online events here at Coffee Microcaps. If you are looking for some institutional grade research on some smaller microcap names on the ASX, please do check out their website. A warm welcome to our friends from ASIC this morning if you're joining us. For anybody who is joining us for the first time, the companies we generally have presenting on here, capped under 300 million, our definition of a microcap. In revenue, approaching cash flow break even, or indeed are already profitable, as will be seen by some of our companies this morning. We tend not to have companies from the resources and biotech on these webinars. So what I like to call industrial microcaps, which kind of covers most other industry sectors. This morning, we jam-packed this morning. We've got 5 companies presenting, each going to get a 30-minute slot, which we break down into a 20-minute preso and 10 minutes of Q&A. If you do have any questions, please type them in the Q&A box rather than the chat function, which makes it easier for me to moderate them to our presenters. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel on Monday. You can follow us pretty much on all the socials. Twitter is probably our main one, YouTube for this recording, and indeed all our other past recordings. We've well over 100 events up there now. LinkedIn, and I do write a free monthly newsletter that you can get on Substack. As you can see, waiting patiently in the wings there, chomping at the bit, is Tony Abrahams from AI Media Technology. After Tony, we're going to be joined by another returning guest, Allan Savins from BNK Banking Corp. Then we've got a new presenter joining us from Perth, Mr. Warren Cook from RemSense Technologies. Then we're going to come back to another familiar presenter, Brendan Malone from Raiz, who joins us from Sydney. And then finally, we'll have another new presenter, Tom Culver from Pharmx Technologies. But that's enough from me. I'm going to stop sharing my screen and hand you over to Tony. Tony, if you want to start sharing yours, I'll let you know once it's live. Yeah, it's coming through now, Tony.
Yeah.
Yeah, I can see the cover slide of your deck now, Tony. You can take it away.
Great. Thanks very much, Mark, and thanks everyone for being here. We released these results yesterday. My name is Tony Abrahams. I'm the co-founder and CEO of AI Media. Over the last 3 years, we've been transforming our 21-year-old business into a technology business from a services business to take advantage of the increases in accuracy that AI technology has delivered. That same breakthrough technology that's given us ChatGPT is that same technology that has finally allowed speech recognition in the initial phase and more language services like translation and dubbing to be done completely without humans. Effectively, we've put ourselves in the position, we think, to get a really good crack at a much larger total addressable market than we had, say, when we went to IPO in 2020. And I'll just run through a little bit of the 5-year strategy to get there. This is 1 year into a 5-year strategy to get to 150 million in revenue and 60 million in EBITDA. 5 key things that we're doing: transitioning to tech, growing tech sales, the underlying core product, transferring that to SaaS through the LEXI toolkit, and I'll talk a little more about that. And then essentially what we're looking to do is replicate the success that we have already demonstrated in one of 9 squares or subsectors of market, which is broadcast, government, and enterprise across the 3 regions, being Americas, Europe and APAC. And then continuing to enhance our product portfolio. This is the graph that we showed last year. So the move from 66 million in total revenue up to 150 million effectively in tech revenue is what we were seeking to do over that 5-year period. And so far, so good. What we've done for the first time now is also break out some operational highlights, because when we're reporting to the market and we've got one product line that's declining, that we're trying to decline, and one that we're trying to grow, obviously a result that puts the two of those things together misses the main point. And then, so in terms of our different revenue sources, we kind of have apples and oranges in the sense that some of our revenue, like hardware revenue, is recognized immediately that it gets shipped. But we actually have equivalent products that we sell per hour as SaaS, which then get recorded over 12 months. So there's a little accounting issue, I guess, in the change from a revenue recognition principle where you recognize it up front to a shift towards SaaS, and then you're going to increase the deferred revenue on the balance sheet. And in fact, the deferred revenue on the balance sheet increased by 2.6 million in the half. And that's effectively the difference between the statutory growth in our technology revenue and the numbers that you can see on the screen there of LEXI volume growing at 48% and LEXI sales at 45%. Our target is to continue to grow the underlying core technology at more than 40% a year across, obviously, compounding over the next 5 years. A couple of really important milestones, KPIs to continue to focus on really is this encoder lifetime value. So the way the technology in the system works is based on effectively this ecosystem that was developed by our EEG subsidiary that we acquired in 2021 for 50 million Aussie. Effectively, what it does is it is the best possible architecture to deliver not just live captioning, but to deliver any kind of AI service in media. Why? Because our encoders sit right next to the raw media input or the fire hose of data that comes directly from the customer. Importantly, it's right next to it. And importantly, also, it is behind the customer's firewall. So it has full access to all of the confidential data natively, which no other system has. And what that does is it actually allows the iCap and LEXI system, which is our internally developed IP, to interface with elements of the stream that are coming from the fire hose. And that's really important because the fire hose has got an enormous amount of bandwidth. And what we're trying to do is we're trying to process that information as quickly as possible because we work in the live media space. So everything that we're talking about now is looking to seek to get competitive advantage and extend that competitive advantage in live video. And we've done this first by taking what was effectively a hardware business when we bought it in 2021. And we've tripled the size of that business just in its home market by selling automatic captioning for the first time. Why for the first time? Well, the technology only just became good enough. And also, the previous owners of EEG were really just in the business of manufacturing hardware. 90% of their revenue was derived and 90% of their profits over 40 years. But what they did do is they did develop the software and the ecosystem that allows effectively second by second and actually frame by frame, and there's 25 frames in a second, to allow those encoders to automatically schedule, orchestrate, and serve up different elements of the audio, video, and metadata to any engine that you could conceive of in the cloud. The cloud basically gets updated every day. As long as someone's still got their encoder that they might have purchased 5 years ago, they will still get access to today's technology via their encoder, because it's connected via the iCap network and connected to the iCap cloud. When we acquired the company, our first half was first half of 22. The total traffic on the network, which was all US broadcast at that time, was 41 million minutes. 3 years later, we've increased the total network to 62 million minutes. But really importantly is the LEXI SaaS usage. So that has gone from being 16% of 40 million to now being 55% of 62 million. And importantly, that product is the highest margin product we've ever sold. So you're, well, how can we be getting so much growth in what is ultimately a really high margin product? And the answer is actually because it gives a lot of benefits to the customers in terms of automation in their playout systems. Also, it provides real benefits above and beyond what you would simply get from an API engine. And the API engine are the things that we put in the iCap cloud there. So if it could be a speech-to-text engine like Amazon Transcribe, it could be a translation engine like DeepL, it could be an automatic dubbing service like 11 Labs. The point is, it doesn't matter which one it is, we put it in the cloud. But whatever engine it is, you still need to make sure you're serving up the right information, the right inputs at the right time to ensure that it's got the right context and it's providing the right output that then can get delivered back onto the screen in the right format. And actually, the formatting stuff has been the biggest challenge, because prior to on June the 30th last year, we were only able to operate in 11 countries on the left there. We've added a further 14 countries in just 6 months because 3 years ago it only operated in the US and Canada. It took us another year to get it working in Australia, another year to get it working in the UK, 6 months to get it working in France. But then once we've done all of that work, now the extra countries are coming on a lot quicker. And that's giving us a lot of confidence that what we said last year is going to hold, namely that we can take a system that was developed for the bespoke standards of US broadcast and extend it into the other 9 squares that we're saying will give us the pathway to 150 million in FY29 of revenue and 60 million in EBITDA. 2 key products we launch this half. So a lot of product development expenses in the first half, and that's LEXI Voice and LEXI Brew. Brand new products. LEXI Voice effectively takes us completely out of the text space, and this is real-time voice-to-voice translation embedded into our customers' workflows. Effectively, it takes a single voice stream, splits it into multiple languages, replicates not only words, but sentiments and emotions. Low latency, exactly the same workflow. This, as soon as we launch this will be available to all of our customers via their drop-down portal. And it's completely flexible to any broadcast needs. Why are we so excited about voice? Well, the total addressable market of voice is about 30 times the size of text to start with. But also, specifically, LEXI Voice is providing revenue growth opportunities for our customers who might be global sports rights holders who are trying to attract micro niches in emerging markets. Also, Sky News Australia is a great customer because they have about 40,000 people a week watching their content on digital in Japan. They don't currently translate it into Japanese. But if you could do that at a cost of $30 an hour, because that's about what cost is, US, per language, to give a really consistent level of quality that's never been capable before. What we then do is we plug that into digital ad tech and look to sell those ads and monetize them for these micro niches who might be baseball fans in Korea. And that sort of hyper-personalized ad, what's the break even for that customer to put that extra language on? How many ads need to be clicked on by how many viewers in an hour for break even? We think the number's 2. So if there's potentially 40,000 Japanese people watching this thing, there is also considerable upside for someone like Sky News if we can get this to the point where it really does replicate the sentiments, emotions, and you almost have no idea whether or not someone was speaking originally in that language or not. It really is getting very close to perfection. And then the second product is LEXI Brew. And this one I'm really excited about. LEXI Voice is launching on April the 7th. LEXI Brew is behind that in terms of implementation. So we've been working on LEXI Voice for about 2 years, and this will be the commercial launch. LEXI Brew is effectively taking the same approach to generative AI as we've taken to with the speech to text. Which is effectively to say, what's the best conceivable way of designing a system so that you can get the best of the ChatGPT-like technology, but keep your data private? How do you then future-proof it? And this is the solution that we've presented to the market just yesterday in partnership with Brew AI, who have really demonstrated a core capability around private large language models and a reduction in what they call hallucinations or errors that you get when you would typically prompt the systems. We had a really very successful early pilot with a new customer segment in finance just over the last few months, and we're quite excited about this partnership, because what it does is it allows AI media to embed AI tools throughout our customers' organization and provides further opportunities for us to continue to grow and continue to add value for our customers to get the most out of their data, to ensure that we've got a real seamless handover between an on-prem solution and a cloud solution. And what we really want to do as a core ad for the technology next is really integrate all of this with our live captioning feed so that things can get updated in real time and alerts sent to someone who's interested in a particular topic that some news event has just updated. And that's obviously not for launch, but that really is what will allow us to extend the competitive advantage that we have in captioning throughout the generative AI. So that's really the architecture of how we got there. And then in terms of financial highlights, this is probably the key slide. Light blue showing the growth in tech sales. The black revenue is our declining services revenue. Really what we're trying to do is we're trying to decline the black revenue as quickly as possible, pull out the cost ahead of that, and grow the blue as quickly as possible. And so really it's 3 completely different business units. We've said we want to effectively replicate what we've done in Americas in the other regions, and we're on track. In terms of our OPEX, we've held G&A stable, we've increased our investments in product, we've increased our go-to-market expenses, and we've had some restructure costs. We expect that trend to continue. We expense all of our R&D and product development, so it's a very clean result. Notwithstanding that, EBITDA for the half was 0.7. We have guided that we expect full year EBITDA to be around 4.1. And that's because we've already done the cost out at the end of December to ensure that we're going ahead of the sunsetting of the legacy human business, which we've said December of 2025, we want to be out by then. So we're expecting total revenue could continue to go backwards. And I know some people get freaked out by that. So if you do, then this is not the time for you. But in terms of the outlook, really, this is the focus. These are the 9 squares. Last half, 98% of total tech sales were in Americas. So it's great to see that down to 89 and to go from a standing start to demonstrate the capability of these products in Europe, which has taken us 3 years to demonstrate because it's complicated. And that's really what we've been doing, what we said we'd do. That's what we have done. For the next half, it's really just going to be more of the same. We want to kind of fill in this grid by FY29. Which way are we going? We'll tell you in advance, and then we'll report against that. So, Mark, I think I'm time for questions. So I might.
Thanks, Tony. I've got 2 in here already. First one is, how has the LEXI recording been received commercially? And then the second one with Brew, does the customer need to buy the encoder hardware to achieve, a behind the firewall security similar to, I guess, what the broadcast customers have?
Yes. So the answer to the second one is yes. There is a private cloud solution as well, but if you absolutely need the security, that's the whole point. You need effectively the same architecture. And sorry, the first question was?
The first question was, how has LEXI recording been received commercially?
Recording or recorded? Was it the recorded service? So we have a recorded service and we have a live service. Most of our business is in live, but we do offer a recorded service for effectively customers who want a quick turnaround. It's building nicely, but it's not a kind of core product. It just kind of adds a little bit of extra cream at the end of the month.
Okay. And then if I can go back to one of the earlier slides, Tony, the one where it was minutes and then the SaaS revenue that was building there as well, and it's becoming a bigger portion. In time, should that be 100%? Will there ever, or do you see a stage where SaaS equals minutes kind of thing, and then it's all about growing minutes? Or is there kind of a natural part of the market that won't take it up, but it will level out somewhere at 80% of minutes or 75% of minutes or whatever the figure is?
We think it'll be 80% of revenue.
Okay.
Which could well be 98% of minutes.
Okay.
Because the non-automated minutes are going to cost 10 or 20 times as much by then. Yeah. But what's interesting is you see this massive market expansion, right? Obviously when the prices have come down, and I don't even think we've started seeing the beginning of it yet. So and once you get the translation tools out there and you can integrate it all so that you can automate and pre-program as easily the delivery of live captions in English, French, and Spanish, and then have translation into Korean, Japanese, Thai, Vietnamese, and 16 other languages. And it could all be paid for by the ad tech at the other side of it. And then you can have a dynamic model to kind of spin up languages on the fly based on who's actually watching it. Like there's so much that you could potentially do now without actually having to kind of take a whole lot of financial risk. And look, if you're talking about an investment of $30 an hour to see how many people you can get to click on something that might give you $15, hey, I'd go to that casino.
Yeah. And I'm just thinking further on to that one. I mean, does that open up, you've got the live broadcasting in America, but I'm thinking about, you're talking about sports or whatever, all these like YouTube podcasts guys who, they're reviewing the game, talking about, the week leading up to games, but it's not live, they record it and they push it out on YouTube or they push it out on Spotify. But I mean, if you've got a huge hardcore number of, Man United fans who are like based in Nigeria or based in Thailand. And, one of their favorite shows, they've kind of figured out, their English is good enough to figure it out. But if you could broadcast that in their first language, I mean, that would be a huge win for engagement, I would think, for them.
And we'll know after April the 7th, right? Like we launched this product, we launched Lexi Voice on April the 7th. We launch it natively. So what you're talking about there is really an enterprise market, right? Which is the bottom tier there. So we're saying, look, it's not a current focus. Our current focus is to work with the market where we've got greatest growth, greatest profitability, greatest market share, and where it's the largest market, which is North American broadcast. Like if we can replicate the success we've currently got with US broadcast, which is largely still English live captions, into just 4 of those other squares by FY29, we'll hit our target.
Mm.
And so there's actually quite a way to exceed the target just by selling more into the top left corner, which anyone who's done an MBA will tell you that's the first place to go, right? So that's what we're doing in terms of Lexi Voice. Lexi Recorded is a little extra on top of that, right? But what we're also trying to do is just to make sure, regardless of what the particular target is, that when this technology transformation is happening, the land grab is on, and you want to make sure that our encoders are the first encoders that get installed in markets where people are making this first transition towards AI services. That's why Europe has been so critical. So Europe has been a greenfield market, and in fact, the US has had like 100% captioning since 1999. Almost all of the new countries we've signed up in Europe have never done it before in 2025. This shows you the difference in terms of the approaches, but also the technology was completely different in US broadcast compared to European broadcast. PAL, NTSC, 30 frames a second, 25 frames a second, completely non-interoperable. We've now made that globally interoperable. We've got it on-prem and cloud interoperable. We brought the costs down by 90% for customers. We've integrated it with their media asset management and playout systems. We've orchestrated the scheduling so it knows what's coming up on the playlist natively, so it can swap seamlessly from traffic to weather to sport to news. That's because of the integrations that AI Media has built since 2003 with our customers' media asset management playout system. Right? It's really important to understand that, but like the core benefit that we provide cannot be disintermediated by a speech-to-text provider. In the same way that Tesla is not a threat to Transurban. Actually, what we are doing is much more like a toll road, effectively, which is taking the information, handing it over from one system to another system, making sure it displays in the right format, in the right country, in the right way for the right viewer in the right circumstance. So we really are a platform for taking this information and these inputs in a live and secure way. And then effectively what happens when someone makes a better engine is it increases demand for our service. And so we've future-proofed effectively the architecture, because every time somebody else improves the core underlying technology, it necessarily improves our underlying product.
Okay. Tony, we're going to leave it there. Thank you very much for taking time out to join us once again. And yeah, we look forward to the second half, and best of luck with the launch of the new products. And I'm sure we'll be hearing about them in due course.
Well, and on that, Mark, I'll just do a final pitch. Follow us on LinkedIn. Follow me on LinkedIn, because we put much more information out on LinkedIn. I've noticed that most people don't even follow us and then complain that we don't put out any news flow.
Okay.
So it would help to follow us if you want some news flow.
Okay. LinkedIn people, if you want some more deep research industry pieces on AI media. Okay, thank you, Tony. And we've got our next presenter here, Allan Savins from B&K Banking Corp. Allan, good morning.
Good morning, Mark. How are you?
Good. Allan, if you want to start sharing your presentation, I'll let you know when I can see it on screen here. Yeah, it's just loading now, Allan. And yeah, if you just want to go to full screen mode, just so we get the full effect of it.
How's that?
Yeah, perfect. You can take it away.
Thank you, and good morning, everybody. As Mark said, my name's Allan Savins. I'm the CEO of B&K Banking Corporation. I'm delighted to participate in today's event and to showcase the B&K story. B&K operates as an authorised deposit-taking institution under the regulation of APRA, and we have a full unrestricted banking licence, and of course we operate and function within the Australian financial services sector. So I'm pleased to take you through the history of the company, as well as our first half, first half 25 results. So we're now in our 43rd year of writing loans and taking deposits. So we're definitely not a fintech. We started life as a credit union in 1982, and we demutualised and listed on the ASX in 2012. A strategic shift in the business model occurred in September 2018 when the bank merged with the mortgage aggregator Finsure Finance and Insurance and non-bank lender Better Choice Home Loans to enhance its distribution, underwriting and loan servicing capabilities. This saw a strategic shift in 2020 with the closure of our two branches domiciled in Western Australia, and origination became online predominantly through third-party intermediaries. It's important to note that all loans are currently sold under the brand of Better Choice and not B&K, and all deposits are sold under the brand of Goldfields Money and not B&K. Funding diversification was established in 2021 with the establishment of a Bendigo Bank Prime residential warehouse and an off-balance sheet Goldman Sachs near prime residential warehouse. February 22 saw the sale of the Finsure business for $152 million, which represented 30 times cash earnings and 2.5 times the book value. And that sale of Finsure strengthened the bank's capital position and supported its strategic expansion into higher margin assets from August of 2022. In March of 2023, saw the acquisition of $150 million of higher margin residential loans from the Goldman Sachs off-balance sheet warehouse program. As B&K already underwrites those loans, they underwrite, service and originate those loans, and they're already on our system. It made good strategic sense to acquire those. We followed that up, given the strong performance of those first tranche of loans in March of 2024. We acquired another $80 million of those higher margin loans from the same warehouse. And in November 2024, we settled a $347 million near prime residential mortgage-backed securitization transaction in the name of Robusta. This was our inaugural issuance of those near prime Goldman's warehouse assets in the capital markets, and B&K participated in that transaction as the originator, the manager and the servicer. And this month also saw the strategic whole loan sale of approximately $220 million of prime residential mortgages within the Bendigo Bank warehouse facility back to Bendigo Bank for an approximate net profit of $2 million. And the first half 25 recorded an underlying net profit approximately $1.8 million, which was up 252% from the prior corresponding period. So in terms of B&K, we are the bank for enterprising Australians. We have a strong focus on shareholder returns. I just lost my notes. We endeavoured on a strategic initiative to move into higher margin lending and delivering, which is delivering our results, and is showing a growth trajectory shift. The focus on selective capital Efficient growth is driving stronger returns for the bank now, reflected in increased interest income and improved margins. Importantly, we have a diversified funding base. At December 24, we had a customer deposit to total loan ratio of 93%, which underscores the stability of our funding base, which is a critical factor to navigating market conditions. And our capital adequacy ratio remains very strong at 26.98%, as at 31 December 24, which is well above both prudential and board limits. And we have a diverse shopfront of products that enables our mortgage broker partners to offer a greater array of products or solutions, as we prefer to refer to them as they're all with the same lender to attract new customers and help our brokers retain their existing customers. And the SME focus has been made possible to target the higher margin, given our accredited mortgage brokers sit at 12,500 across Australia. Our results overview, importantly, looking at our first half results. So we continue to reposition the balance sheet, which is showing strong momentum for us. The banking sector continued to face challenging market conditions throughout the first half of 25. Higher interest rates did place pressure on margins, and while competition for loans and deposit customers did remain intense, despite all this, we managed to achieve an underlying NPAT of 1.8 million, up $3 million from the previous corresponding period. This represents the last 10 months of consecutive positive underlying NPAT for the bank. Stat NPAT also improved to a positive of 320,000, up 2.1 million from a first half 24 loss. Some other call-outs: our net interest income was up 29% to $11 million compared to the prior period. Our total income was up 58% to 12.8 million compared to the first half 24, delivering positive jaws, as underlying operating expenses only rose by 11%, reflecting a balance of investment, disciplined underlying expense management, and inflationary impacts. And the net interest margin for the first half 25 continued its positive momentum as anticipated in the first, as anticipated in FY24 financial results. And net interest margin improved up significantly, up 47 basis points compared to the first half to 1.39%. This demonstrates sustained progress over the year, with improvements driven by disciplined pricing strategies, a focus on higher margin lending, and careful management of our funding costs. These results highlight our ability to navigate margin pressures effectively while positioning the business for long-term profitability. Looking at our half-year results, our statutory outcome and underlying outcome both showed a marked improvement from the losses in the prior comparative period, with both showing a positive growth for first half 25. And net interest income, as I touched on, of $11 million, was up 29% to prior comparative periods. Our net other income was a net improvement in both statutory and underlying terms, with income from the robust securitisation trade and continued fee income from our origination and servicing activities generated from the Goldman Sachs Warehouse program. Important to note, the NPV impact from the rundown of our legacy mortgage management book is really the only difference between statutory and underlying income, and is consistent with prior period treatment. Underlying expenses, as I touched on, were up 11% year on year, with selected investments, careful expense management, but also inflationary pressures. We saw vendor expenses associated with our technology upgrade to the tune of 845,000, and that included that was included in our statutory results, but not in our underlying results. Credit loss expenses for the period was actually a net write-back of 85,000, with a reduced book and reduction in our overall arrears in the 90-plus day category. The summation of the above led to a profit of 320,000 for statutory results and an underlying profit of 1.8 million, which is a significant improvement of the underlying result for first half 24. In terms of our key metrics, our balance sheet footing showed a decline year on year, consistent with our strategic aim of moving away from low margin, low profit residential home loans. Our loan book reduced 20%, while deposits reduced 29%. Net interest income improved 47 basis points for the period, as I mentioned earlier. Our underlying cost-to-income ratio was 81% as we moved into profitability. Our capital ratio improved on both the Tier 1 and total level, largely from a reduction in the loan book, but in doing so, creating the capacity to invest in selected higher margin assets. And our net tangible assets still remain at approximately $1 per share. In terms of our loan book, deposits and net interest income, as I mentioned, since first half 24, the loan book has decreased by 20%, reflecting the impact of our strategic focus to transition away from lower margin prime residential loans. While this shift has naturally resulted in a smaller overall portfolio, it has allowed us to prioritise higher margin opportunities that will support sustainable long-term growth. We remain focused on accelerating the growth of profitable new business in line with our strategy to optimise the portfolio and deliver improved and sustainable returns over time. To provide context of the current balance sheet size, the portfolio is now comparable to the first half 23, where the business reported an underlying half-year loss of $1.4 million. However, following the gradual release of lower margin, lower profit prime loans, underlying profit had strengthened to $1.8 million positive. So growing the loan book alone is not always the solution. Profitable growth is the key to success and remains the primary focus. The deposit book has decreased by 29% since first half 24, as expected, outcome aligned with the reduction in the loan book. Notably, the deposit decline has been managed at a greater rate than the loan book reduction, reflecting a deliberate strategy to optimise our funding mix. This approach has allowed us to strategically manage the runoff of more expensive term deposit funding, contributing to an improved net interest margin and supporting our focus on maintaining a balanced and efficient funding profile. Net interest income reached $11.1 million, up from $8.6 million in first half 24 and $10.7 million in second half 24. This shows a solid improvement in the prior half year and year on year. While we've seen positive momentum, but as we've experienced in the past, the trajectory of growth is not always linear due to competitive market forces. But we remain focused on managing these dynamics and maintaining a strong and resilient performance across the business. The lending portfolio itself remains stable from a risk perspective. The portfolio's payment structure remains largely consistent, with over 80% of loans continuing its principal and interest. This stability underscores a lower profile risk as borrowers steadily build up equity in their properties. The composition of the residential loan book has remained stable between owner-occupied and investor loans over the past year, reflecting a balanced runoff across the segments. And our goal remains to optimise returns while maintaining a strong diversified lending base. High margin assets now comprise approximately 22% of the portfolio, secured by either residential or commercial property. While this shift has been influenced by the reduction in the prime loan book, we've also taken the deliberate steps to expand this segment. Our target remains to reach 30% over the medium term, and we are steadily progressing towards this goal through a balanced approach to portfolio composition. We've seen a positive shift in the loan-to-value ratio mix over the past year. In the first half 24, 32.5% of the portfolio had a loan-to-value ratio of up to 60%, compared to 37.4% in the first half 25. Meanwhile, the portion of loans with a loan-to-value ratio between 60 and 80% decreased from 60 to 56%, with the balance above 80% loan-to-value ratio remaining relatively stable. This reflects the current portfolio dynamics and our ongoing focus on maintaining a strong risk profile through a balanced LVR mix. And our portfolio metrics continue to be healthy. Our offset balances have decreased slightly, moving from $79 million in June 24 to $77 million in December 24. So this change reflects continued strength in customer cash flow management, with balances remaining at robust levels. As at December 24, approximately 45% of our loan book is ahead of their loan repayments, up from 42% a year ago. This improvement highlights the financial resilience of our customers and their ability to manage repayment obligations effectively. These metrics continue to provide an effective buffer for our borrowers. At December year end, we only had one mortgagee in possession case that has since settled with no financial loss experienced, reflecting the overall strength and quality of the portfolio. Fixed rate loans represent just 4% of the portfolio as at December 24, significantly reduced from 16% a year earlier. By the end of FY25, we expect negligible balances remaining in the fixed rate portfolio, which is consistent with our strategy of not originating any new fixed rate business. In terms of our credit quality and arrears, the increase in the borrowing rates for customers and households pressures led to more elevated arrears through most of 2024, but we saw some moderation towards the latter quarter. Our greater than 90 days arrears sit at 0.47% on our residential loan book, and this represents a very small number of accounts. The aggregate total for 31 days plus sits at 1%, which is our lowest over the last 12 months, and well within line with industry standards. Given it only takes a few accounts to move this percentage, we can see quarter to quarter volatility, but we remain of the view that our risk position is broadly stable. The recent reduction in the OCR, being the official cash rate by the Reserve Bank, should assist customers, and we have passed on the full 25 basis points to our lending customers. And our commercial arrears remain within tolerance, with our 90 plus days arrears sitting at 0.98%, consisting of 4 accounts. And we'll continue to monitor closely as this book cautiously grows. In terms of B&K management team, a very experienced team with a minimum of over 30 years experience, myself being over 40 years in the financial services industry, 17 years initially at a major regional bank, 18 years in a non-bank environment where I was the Chief Operating Officer and Chief Commercial Officer of non-bank lender RZI Limited. I've been with B&K for 6.5 years, and I've been the CEO for the last 3 years. Likewise, I have a very experienced board driving the next phase of our growth, importantly, which is led by our Chairman, John Denovan, Special Counsel at Dentons, who's the first honorary member of the Mortgage and Finance Association in Australia. Some other call-outs is David Gratian, who is a First Mac board member, and Warren McClelland, who is a ResiMac board member and associated with Summers Limited, both of these two entities being our largest 2 shareholders. So as we look ahead, we recognise that business transformation is a continuous process. Our strategy is centred on driving sustainable growth, enhancing margins, and improving profitability. Our approach is supported by diversified income streams and strategic portfolio shifts. Our focus remains on optimising our asset mix, prioritising high margin lending while ensuring cost-effective funding sources. The recent partial Bendigo Bank warehouse sale demonstrates our ability to unlock value and recycle capital for higher margin opportunities. Asset mix adjustments will continue to play a key role in optimising our net interest margin and capital efficiency as well. In parallel, we'll also advance our technology enhancements, aligning with the bank's goals of risk compliance and operational aspects, together with maintaining a strong focus on cost discipline. We're pleased to observe the continued resilience of our customer base amid the challenges of the high interest rate environment and inflation, with approximately 45% of our loan customers ahead of their repayments. This resilience is further reflected in our improving residential arrears, even as the loan book has shrunk. And our longer-term arrears for the commercial portfolio has improved over the same period. We remain well provisioned and confident in our ability to navigate the evolving economic environment. Additionally, we'll support the ongoing stability of the Goldman Sachs off-balance sheet warehouse, which remains a key pillar in our revenue growth strategy. And we are well positioned to leverage any improvements in the economic environment, enabling us to drive forward our strategy effectively. But we recognise that progress may vary from the current trajectory and could fluctuate due to competitive market forces. So in conclusion, B&K's strategic shift towards high margin lending is delivering results. The focus on selective capital efficient growth is driving stronger returns, reflected in increased interest income and improved margins. While lending settlements have declined in line with this strategy, the quality and profitability of the portfolio continue to strengthen. With a solid capital position, B&K is well positioned to sustain a strategic direction and long-term profitability. So in closing, I thank you for the opportunity to showcase B&K business, and I'll now happily take any questions. Thank you.
Thanks, Alan. Yeah, we got one question in here already, and it relates to, I guess, you're trading at a big discount to NTA or book value, whatever you were at yesterday, 30 odd cents versus give or take a dollar. And our questioner wants to know, what is kind of the board's view on that, given, your strategic shareholders are in some ways competitors as well, in some senses. Is there a plan to, with the excess capital that's there now, take some of that as like a capital return to try and, narrow that discount or reinstate the divvy? I think the last divvy was 2022, if I remember correctly, is kind of
Correct.
the start of this kind of 3-year transition period. I remember was the last one. What's kind of the discussions at board level of strategies to kind of narrow this discount and get it more in line with, a lot of the other banks which are at book value or trading above book value?
Yeah, that's a fair question. It's a conversation that we have on a regular basis at board level. We obviously there are some components that we can't control, so we focus on the components that we can control, and that is more on the lines of reinvestment back into the bank and trying to grow that sustainable profitability. I think first and foremost, it was to reach that beachhead of sustainable profitability. So the fact that we've had 10 consecutive months now of positive underlying cash profit is a sign that we're starting to demonstrate sustainable profitability. So it's a case of growing our business, and moving into the high margin assets does mean that's more capital intensive as well. So we'll continue to recycle our capital from the lower profit, lower margin business from Prime and reinvest that back into our growth aspirations. Now, remembering any potential, share buyback opportunity needs to be approved by the regulator as well. And I think that given we've been on only a recent trajectory of the last 2 years of growing out our high margin business, it's something that the regulator would opine on in terms of, is it too premature for us to be considering a share buyback? The last thing we want to do is do a share buyback and hand capital back and then be asking for it back again in a year's time, if that makes sense. So for us, it's a case of we need to focus on our fundamentals, improve the performance of the bank in terms of profitability, and that's our immediate focus.
Okay, great. And then I want to just touch on the competitive environment. Now that we've finally had this like one rate cut, whether we get any more now is up for debate, that, and it changes daily. But maybe if you can just touch on, because I know it was very competitive space over the last 12 or 18 months. Now that we've kind of finally got the rate cut, what is the space out there for selling books, buying books, getting in new business, opportunities for warehouse funding? Maybe just give us a sense of where the environment is currently for B&K.
Yeah, happy to. So for us, I mean, nothing changes. I mean, everybody's passed on the 25 basis points, so it's really just net exactly the same. I think importantly, we need to keep a close eye on our retention. But again, we're more than happy to slowly reduce down our low profitable loans and to free up capital for the high margin strategy. So for us, it may help from a serviceability point of view to write more loans. It won't mean that we change our lending standards in any shape or form. We've been growing out our high margin strategy cautiously and in a very considered way. We'll continue to do so. So it's about, for us, having those relationships with those respective distribution entry points, i.e. the mortgage brokers that we have today, building those relationships, having deep relationships with those to get repeat business, and then backing that up with the old cliche of service. So, pardon me, efficiency in the office. So for us, it's really about nothing changes. It will remain a competitive landscape for us. We are very big on 80-20 rule, so I'd much rather form strategic relationships and build that depth. Now, there is opportunity for us to consider, looking at different ways for high margin. Organic is one way, of course, to grow the balance sheet, but also inorganic as well. So absolutely, I'm always looking for portfolio acquisitions or strategic partnerships to move forward as well. So it's one that we're constantly in dialogue with various originators around as to does it make sense for us? But for us, it's not. We've been the victim to some degree of tremendous growth over the years, but that hasn't necessarily led to a profit. And I firmly believe that, growth for growth's sake is not the right strategy. So for us, selective growth is where we need to be. So we'll continue to I guess, grow at our own pace and make sure that we make the right investments of our capital.
And funding mix, that's also been evolving over this kind of transition period. If we're to look out another 3 years, if we say, look, this 3 year period is kind of coming to an end now, let's say June 30, and we look out another 3 years, what is kind of the funding? Will it look kind of similar to where you're going to finish out at FY25, or do you see it, kind of going through another metamorphosis in the next 3 years as kind of the high yield strategy comes in, and a lot of these other loans kind of slowly exit the book?
Yeah, so from the liability side of our balance sheet, I mean, we have deliberately released our high cost deposits. So we had a high exposure, around 50% of our book was sitting in term deposits. We've been positioning ourselves from a balance sheet perspective for some time, expecting a rate cut. So we've gradually let those, again, expensive term deposits run off, and we've changed our funding mix more to at call. So where we sit today, for example, we would be 30% term deposits and 70% at call. So that has enabled us, off the back of the official rate cut, to actually move on that faster than what we would with having term deposit funding locked in. So I think it's a case for us. It's about getting that liquidity mix right and our funding mix right, in the sense of what percentage of term deposits and duration that we want to put into the balance sheet versus what we're willing to risk from a net call perspective. So we've deliberately done a good job at winding off the high cost term deposits, putting that in the lower cost at call. We'll get a yield pickup as a result of that on that compositional change. And we'll keep playing that process out. We'll look to put some more duration potentially into the book. Now, I don't see there'll be another rate cut personally between now and the election. So I think we can start thinking about now a little bit more duration in the book to give us that funding stability as well. And that's the secret sauce. If we can deliver a good cost of funds and make sure we deploy our capital into the right margin asset, that's the profit signature strategy, really. So there's no point writing a loan at 6 if it costs you 5% to originate it, because you're not going to make any money. So the point of it is to drive down your cost of funds, and we've done a good job at that, and I think that will continue. And then the more we expand our high margin opportunities, the more greater gross profit we'll make on those loans, and the more profitable and sustainable profitable outcomes should result.
Okay. And in terms of going the direct method, if we can focus on that for a bit, because I know there's a lot of buying books, selling books, dealing with the broker channel, but I know that there's also been a kind of a big rebranding has gone on as well. How do you feel that's kind of got traction in the market? Because obviously you've got some like very big players who have very big advertising budgets. Is it more getting onto the comparison websites and getting yourself positioned there, so that when people are searching, they can see you and you're in there and you're competitive, rather than you're doing advertising campaigns on Channel 7 or whatever it might be, or on the radio?
Yeah, that's a good question. We are going through a branding consolidation. I mean, part of our tech transformation this year is to actually consolidate our business into the one brand. So instead of selling loans through Better Choice, they'll be sold through B&K Bank, and the same for deposits. And I think once we improve our website and be more customer-centric on that, absolutely we'll play at those sort of affiliate marketing type approaches as well. I mean, at the end of the day, that is more of a funding distribution mix as opposed to a yield play per se, because if you move on those particular sites, you're still going to have a good interest rate anyway. So it won't really give us any there'll be no special pricing going on there, or still costs us similar to what it costs us through the current model, less the broker commission that we pay for the current model. So it won't really change the dial materially in terms of our net interest margin per se, but it will give us good diversity in our distribution of deposits. And that's absolutely a key thing that we're looking to stand up over the course of the next 12 months.
Yeah, that's kind of where I was going. Yeah, getting your brand out there and getting,
Correct.
volume through that channel as opposed to, being solely
That's right, Mark. I mean,
any broker
that's
model.
right. For me, I don't want to be investing into the Goldfields Money brand if that's not going to be our go-forward brand. So if our go-forward brand is B&K, which it is, therefore we are quite light touch at the moment because I think that that's a sunken cost. So once we consolidate our brand, then there'll be the necessary investment made into that channel to build up that brand equity for B&K. And then you'll see us more on those sort of affiliate sort of sites that you mentioned.
Yeah. Okay. Allan, thank you very much. We'll leave it there, and hopefully we'll catch up with you possibly at the full year result in August, September.
Great. Thank you, everybody.
Thanks.
Appreciate your time. Thank you. Enjoy the conference. Bye-bye.
Thank you. And we'll switch now quickly over to Part. And I'm delighted to say we're welcoming a new presenter, first time with us, Warren Cook, CEO of RemSense. Warren, good morning.
Good morning, Mark. Thank you. Thanks for having me.
No worries. I hope everything's well in WA. If you could share your presentation, I'll let you know when I can see it coming through.
Now,
Yeah, it's just loading now, Warren. Just give it a second. Yeah, if you want to just click on.
minimize this.
Yeah, there it is. And
Hey,
yeah,
so we're good to go from this end.
Yep, that looks perfect on my side, Warren. You can take it away whenever you're ready.
All right. Thanks, Mark, and thanks everyone for joining online. RemSense, yeah, we're new to this forum, so thanks for Mark for giving us the opportunity, and I'm very excited to be able to be here and present the story of RemSense and where we're heading. So to be there without going there. So that's a fundamental underpinning tagline in which we operate, and this will become blatantly clear as we move forward. So first of all, the board, we're a small, very experienced and loyal, committed and stable board. We've got decades of global industrial experience working with, I've said they're tier one clients, but right across the board from juniors right through to tier one. I've been in the tech space for 25 years this year, building tech companies, and have been CEO of RemSense for 18 months and other tech companies since 2009. So to understand where we've been, I want to walk you down memory lane. So RemSense listed in 2021. Prior to that, we go way back to 2006. That's the origin of RemSense. And back in 2006, we were designing and manufacturing drone systems for defense and industry, way before drones were a common thing. And drones are still very much part of our day-to-day business. And 2012, we started delivering drone services with those drones that we designed and manufactured and covered a lot of services. So more recently, and before we actually listed, we started to evolve into a tech company, and now we're a technology company driving industrial digital transformation through what we call a visual twin, an advanced visualization platform with centralized insights. And that platform is Virtual Plant. It's a high-resolution 3D photogrammetry platform which delivers this immersive asset visualization experience. And I'll go into that in a little bit more time. We released our interim results Wednesday this week, and I'm really pleased that they were really well received, and we're very proud of these results. For the first half year of 2025, our revenue from ordinary activities is up 178%. So we went from we achieved 3.1 million, up from 1.12 million in the equivalent half year in 2024. And net profit, so we achieved our maiden half-year profit, a profit of just under 800K compared to a just over a $1 million loss in the equivalent half year again in 2024. So EBITDA up 297%, great result for us, very proud, heading in the right direction. We've got an underlying EBITDA of $1.5 million adjusted for share-based payments, up from a loss of just under 800K in that, once again, equivalent half year. So that also put us in a cash positive position. Operational inflow was 365K compared to an outflow of $857,000 in that previous year. So we're very excited about these results. It's going to set us up for the coming years. So our revenue streams in RemSense, we've got two main revenue streams. It comes from our SaaS platform, Virtual Plant, and our PaaS services. And you can see where they overlap and they integrate as I go through. So to understand RemSense, you really need to, well, understand RemSense and the potential RemSense has. You really need to understand the product we have and the potential these products that we deliver have as well. So Virtual Plant, it's a high-resolution 3D asset visualization platform that provides capability to remotely view and interact with your facilities via an intuitive, immersive experience. So in general, we talk about an equivalent experience that people can immediately understand is Google Street View on steroids, but in a high-resolution industrial environment. So I think everyone at some point would have been in Google Street Map and wandered along the street, had a look at the real estate or the destination of an office that we need to visit. RemSense, the base experience is very similar to that. You can wander through these industrial environments, but at a much, much, much higher resolution where you can zoom into small screws, like it's a very high resolution, and that is fundamental. We offer the highest resolution photogrammetry on the market. So that's the first of all. So with Virtual Plant, we have two levels of experience. There's this inside, and this is where asset managers, maintenance planners, they can access their facility and see this type of detail from anywhere at any time on any device. So the benefits are that we commonly work with oil and gas mining, very remote sites. They are hard to get to. They take a long time to get to. They're expensive to get to. And then once you're there, the level of accommodation and the ability to be on site is scarce. So being able to do a lot of this work remotely is extraordinarily valuable to them. In addition, without the high number of people on site, that then brings into risk mitigation. You've got less people on site, you're keeping people out of harm's way. So the insides of people, we capture that through a variety of technologies, 360-degree cameras. We use LiDAR, which is a laser technique, and then we have other imagery and spectral cameras which we are overlaying on that imagery, which adds the secret sauce to what we do. So the other part is where the drones actually still come into play, which is the outside. So we use our drones to capture the aerial aspect of the facility, and we build up high resolution mesh models of these. So that reduces at-risk activities. So inspectors and asset planners can inspect these facilities at heights. That eliminates workforce having to work on ropes, erect scaffolding, personnel platforms. Anytime that you've got to put a person at heights, you're putting them at risk. So that's one of the reasons people would use Virtual Plant. So the value we deliver using Virtual Plant is right across the border of an operation. That's why this is so valuable. It's not just specific for one very small part of an operation. It's across the board. So just some of the use cases of virtual plan. Just the ability to wander through, instruct people of what the facility looks like before they actually arrive on site, training and inductions. And that immediately puts people at ease and much safer. So they're immediately familiar with their operation once they arrive. Maintenance planning, you can plan these maintenance activities before, without going to site. And if we're talking about these vessels on water, you can plan all those maintenance activities prior to these ships getting into port. Port time is expensive and it's rare or scarce, if you like. So being able to hit the ground running with all the tasks planned ahead is also extraordinarily valuable. Asset management, and I'll talk about this. This is a big part of what we do. Being able to support the whole asset management cycle, being able to create automatically an asset register. Now, this is important from a legal perspective, from an insurance perspective, and a maintenance perspective. So we're able to use the photogrammetry and run an AI application to generate an asset register. And I'll go into that in a little bit more time and show you really the value that delivers and the risks that will happen if you don't do that. Remote inspections, I've already really alluded to that, where anytime, anywhere on any device, you can have a look at this imagery and do these remote inspections without having to travel there. And you can share this with consultants, contractors, saving a huge amount of money. And that really relates to reducing legal and insurance risk of this facility. So just some of the benefits that virtual plan then delivers based on those use cases is safer. It's clearly safer, and there's far fewer accidents because you're having less people on site. You're making people much more familiar with the facility, reducing turnaround and shutdown durations. Now, when you shut down these complex industrial facilities, it's an expensive exercise. One, to actually do the maintenance, and when it's shut down, you're not producing. So to actually shorten those production times are extraordinarily productive. Like up north on the northwest shelf in these LNG trains, they typically can get shut down for 30, 35 days. When they're not producing, they're missing out on in excess of $15 million worth of gas per day if you're looking at LNG trains. Anytime you can actually shorten those shutdowns, you're actually producing more gas, $15, $30 million per day. So the return on investment using virtual plan can be tenfold or 100-fold. And just reducing unplanned maintenance. Unplanned maintenance is the enemy of any business. Everyone likes to have things being certain and being known. If things fail and plants get shut down, that's not a good situation. So using virtual plan again, you can have these regular maintenance, and that really fits into the asset management that I spoke about earlier. And I'll bring all those benefits together and the use cases in a little bit more time. So I'll reiterate this: unnecessary travel to site. Now, we're all wanting to, in these days, social fabric, keeping families together. I've done FIFO for a long time. It's great, but nothing's better than being home with the family. So being able to limit the number of people that are required to travel to site, be away from their family, being put in harm's way where you're in these high-risk industrial facilities is always a challenge. And it definitely reduces these at-risk activities. Let's look at some of our mining customers. They have large crushers. in the crushing and processing facilities that reduces hazards like dust. There's been circumstances where there's been things like silicosis. Now, that's unfortunate. Now, just think about a scenario where you can sit remotely and be able to do your work without having to step outside the office, wander down, put on PPE, and inspect the primary crusher where there's fine airborne silica, or being in a hazardous environment where there's potentially it might be an aging facility in a decommissioning, or well, let's just say an aging facility where there might be other hazardous materials like airborne asbestos. As these facilities degrade and start to break down, you get those other risks. Improved planning, accuracy, and efficiency. Well, with this level of visualization and other insights, you can increase the accuracy and efficiency of using a product like Virtual Plan, because you know exactly what is there. It's the reality. It's reality capture, which we call it. You can see and inspect what is in this with this environment. So training inductions, nothing's better than bringing in a new employee on and being able to train them in a comfortable, safe environment without having to walk them around a site which they're completely unfamiliar with. So let's move on and look at a little bit of history of where we've got to now from older technology. So on the left is often called a BIM model, Building Information Model. Now that is a CAD model, and this is very much still used today. Most facilities in which we work will have this CAD engineering BIM model. What we're now seeing, and which is pretty much why we're in business, is users and companies see the value and want to work in this reality space. So you can see the comparative difference between a BIM model on the left and this reality capture on the right. A BIM model is only as good as when it was first designed. Now, when it's construction, there is compromises, there are changes during construction, and that BIM model typically isn't created. So let's have a look at how that history evolved, and which is parallel to where we're at now. So these BIM models started to come into play right back in the early 60s, in the early digital concepts in the construction data. And 30 years later, with the likes of AutoCAD, which is a large organization, probably familiar to most, a CAD software, BIM models started to become very widely used. To the point now in 2000s, it's pretty much common, and the governments started to encourage this adoption because they can see the value in having these BIM models, to moving into the 2010s, where government, specifically the UK, said this is mandatory. So BIM then went mainstream. It was a requirement. It was mandatory for any construction. Now, fast forwarding to where we are, I'll just move this down. I gather you can see that. This BIM and digital twin. So digital twins now are front and center to the industrial operations. They're looking to leverage the capability of these digital twins, making the whole operation, bringing in the operational parameters, the design, the P&IDs, everything into creating a digital twin of an operation. So now we've got these BIM models, and digital twins have converged along with reality capture. So this is where we're at now. This is becoming standard. Users are wanting to use as is reality environments rather than potentially outdated, inaccurate BIM models. So this is where we will move. So you can see the parallel to where we've developed, but now technologies are accelerating so much faster. I'm not saying we're on a 60-year time frame here. Things are changing rapidly, and this will be a standard. I'm expecting it will be standard within the next couple of years, where when people start operations at the end of commissioning, they will have this high resolution reality environment. So let's look at the markets where this actually sits. Now, RemSense, we're well established within the oil and gas and mining. You can see from those earlier images, this is bread and butter for us. High risk, complex industrial facilities, which are hard to get to. So offshore platforms, these FPSO boats, rigs, and anything really related to oil and gas offshore is a complex, high risk, difficult to get to environment. Then you've got the onshore facilities like LNG facilities and refineries. They're very complex, they're abrasive, they're high risk. So being able to inspect, operate, and facilitate the operation of those remotely is hugely valuable. And then that equally in the mining environment, and more specifically in metals mining, let's say, where you have gold, lithium, alumina, nickel, uranium, where those processing facilities are complex. There's a lot of infrastructure, assets, piping, etc. It's those are where you really want to use virtual plant and get the value from this visualization. That's not saying that operations in the bulk commodities, for instance, like coal and iron ore, there's not a use case for that. There absolutely is a use case, but for us, there's a focus on these very complex, high-risk environments. So immediately that's where we're going to focus our experience. So in addition, where we're heading, digital twins and the use of visualization is big in utilities. So this could be green hydrogen, renewables, power generators, power utilities, water utilities, all have complex facilities that require high maintenance, and it's often remote. We've already embarked on a defence journey. You saw back in memory lane where RemSense started its origins in 2006, designing drones for the defence industry. So there's definitely a use case in defence, and we've been engaging in defence stakeholders for the use of virtual plant in that market. So we're on that journey. Then you could go to just general marine, offshore, high maintenance, very, very similar parallels to the oil and gas FPSOs, these floating petroleum storage and offtake ships. And then you can get into industries like aerospace, the facilities in and around those complex technical. So there is billions and billions of opportunity within all of those markets. So virtual plant has a huge opportunity across there, and it will just continue to grow as we develop those markets and build our sales pipeline. So on top of that visualization, this is our secret sauce. This is where really the rubber hits the road and you get accelerated value. Asset audit. Now, I touched on that. This is where there's legal and insurance ramifications to that. Many people have out-of-date asset registers. So let's say all companies that have an industrial facility with equipment all have a asset register of some type, whether it's an Excel spreadsheet, whether it's a fully sophisticated, dedicated asset platform. you have a register. You list all of those assets. And with having those assets listed and registered, you're then able to create a formal maintenance program. And you know where, for the accountants, you can create a capital value of all those assets. And then that leads to insurance. You know where that asset sits, the condition of that asset, and the value of that asset. Now, what we commonly see is, as I mentioned earlier, those asset registers are way out of date. So we've built an AI-driven asset identification platform. So it then scans through all of this high-resolution imagery and pulls out asset tags and be able to automatically create an asset register from that imagery. So that's the first part. We must have high-resolution, high-quality imagery to then run all of our secret source applications on top of that. So we often talk about ghost assets. These are assets that sit on a register that no longer exist in the plant. So that is a risk in itself. So with that, you're inflating the asset value or the facility value because that asset no longer exists. You're also increasing potentially your insurance premiums because that asset no longer exists, but you're insuring it. Now, the alternative, which is probably, let's say, even higher risk, is assets that exist within the facility that no longer, well, that doesn't exist within the register. That is risky because no one is really aware of that piece of equipment. Could be a pump, could be switchboard, could be cabling. It's not in the register, therefore no maintenance program has been created for it. So it's potentially not going to be maintained. That happens. If it's not maintained, it fails. You end up having this planned downtime, planned shutdowns, which is the enemy of any producer, any technical or industrial facility. It also then leads to, it's not on the register, therefore it's not being insured. So your insurance premium, well, it actually doesn't include your insurance premium, but if you have a, let's say, destruction or some tragic destruction within the facility and you need a claim, that those assets or the entire facility will likely be underinsured. Therefore, your claim is less. So a major risk to the sustainability or the ongoing operation of your facility. So in addition, you can also, once you've identified those assets, so from an operational perspective, you can sit in this high resolution, very immersive, user-friendly environment, sitting in the luxury of your air-conditioned workshop or office and monitor the operational parameters. So we connect to those process historians like IBM Maximo, SAP, or any of those sensor providers who measure operational parameters. Might be power draw of a pump, could be flow rate, could be vibration, could be temperature. Operators can quickly identify inconsistencies within the operation parameters and then be able to dive, and if they identify an inconsistency, they can then dive into those source applications. So we're not looking to replace SAP or Maximo or any of those systems. It's just a complementary platform in which they can then detect and then jump into those source or the origin applications for greater analytics to determine the issue. The other thing is automated defect detection. So with this imagery, you can detect lots of defects. So we've got automated corrosion detection. So this really improves the focus on remediation efforts. So from a maintenance planner, it helps them prioritize their efforts without having to do intensive walkarounds, which is typically the workflow. These inspectors have to do regular walkarounds on the facility, putting them in harm's way in a high-risk environment. So you can do all that. So once you've identified these defects, could be crack, could be other cracks, or could be other defects, that can then trigger work orders to actually get these defects remediated. So the other part of our business, I've already mentioned our RPAS, which is remote piloted aircraft systems. That is very much part of our standard business. That's where we originated from, and we use that to capture a lot of our imagery. But because we actually have these in place, we have a lot of capability and skills within this space. So in-house, we've got highly experienced and qualified pilots.
Sorry, Warren, I just cut in there for a second. We're just up on time, unfortunately.
Okay. I've got a couple of minutes.
Yeah, can we maybe just leave it there, or can you just tab to maybe the last slide?
So it's just all about services delivery, primed for growth. So, we've established these clients. We've got global partnerships. So we have service delivery across the globe. We've got partners in the US. We've got partners in West Africa. We've really set ourselves with the technology partners, and there we are. Sorry, mate, I get quite passionate and interested about this stuff. So,
it's okay.
It's hard to slow me down. All right.
Yeah, but I did just want to get to this slide. Yeah, so because we've run out of time for questions there as well. If anybody does have questions, to please reach out to Warren. And I'm presuming that this results deck is on the ASX platform as well.
It is, yes.
Yeah,
it is. Okay. That's been loaded up as of this morning. So I chewed up 30 minutes just then.
Yeah.
Wow.
It goes by when you're quickly when you're onto a story you're passionate about. As you
passionate about, yeah. I like more than the sound of my own voice. This is a great product. I hope people see the value in it. We're on a great trajectory. Yes, reach out to me for any questions through RemSense, info@remsense.com. There's a bunch of us that receive that, so it won't get missed, and we can respond to any of your questions.
Beautiful. Warren, we'll leave it there. Thank you very much. Have a good weekend. And we're going to cross back from WA to Circular Quay in Sydney. We've got Brendan Malone joining us from Raiz Invest. Brendan, good morning. He's sharing his screen. I can see him loading it here now. Yeah, just go to play from the start, Brendan. It'll probably no, if you want to just go to presenter view, just so we get the full screen effect. Yes, there you go. That's perfect, Brendan. And if you want to take yourself off mute as well. No. Okay, your Prezzo looks good now, Brendan. Oh, no, it's good. It seems to be switching between.
Hear me now?
I can hear you now. Yeah, your Prezzo just seems to be switching between the two. Maybe just tab to the second slide there.
Better?
Yeah, that's better. Yeah, there we go. That looks good.
And you can hear me. Perfect.
Yeah, we can hear you, so you can take it away.
Lovely. Well, good morning or good afternoon to wherever you are located. It's been 12 o'clock here in Sydney. And thanks for having me back again, Mark, and the Micro Coffee team. I'm pleased to run through these results today, in particularly after the release yesterday. And we're very pleased with the momentum that we've received and seeing the strong positive momentum in the core Australian businesses going forward. And a lot of people who may have been following the business over the last couple of quarters or halves or years, you'll see that there is more information in this deck, and there's some new themes introduced, being things like the underlying earnings before interest, tax, depreciation, etc., to really make the go-forward business transparent and clear on what we're doing and where we're going. So let's just jump straight into it here on the highlights. And we've split this out in two parts, the financial metrics and the business metrics. Firstly, on the left-hand side, the financial metrics, revenues increased by 14% to 11.6%, which is up 14% or over 14% for the period, with underlying EBITDA improving significantly to just over 700,000. The underlying EBITDA excludes share-based payments for employee share options, a one-off STI timing adjustment, and the non-recurring items such as our R&D grant, which is again what I say. You'll see through these results that we're trying to provide a clearer view of the company's core performance. The comparative figures have also been restated to reflect the discontinued operations, as anyone that has been following can see that we've exited, Raiz has exited from our Southeast Asian operations. So what we're really trying to do here is to make it very clear the continuing underlying operations earnings of the business really clear and transparent, so investors can get a real sense of how the business is tracking. You can clearly see that we are actually at an inflection point in the business as it transitions to operating profitability. Our operating cash flow from continuing operations was 1.6 million down in the bottom left. We've also included in these results another line, which is the calculation of free cash flow, which is our operating cash flows, which includes product development and CapEx, and that's some feedback we had from shareholders over the last reporting period. So we've broken that out and made that very clear. The free cash flow number captures the tech spending or the capital costs, which is still positive for the third consecutive half. A strong cash balance of 12 million, which was strengthened off the back of the capital raise we did in August last year, where State Street Global Advisors took a strategic stake, or just under 5% in Raiz, and this added just under $4 million in cash to strengthen our balance sheet. On the business metrics side, on the right-hand side, which drives the financial metrics, we have active customers up 8.5% for the prior year, and importantly, we've added another over 7,300 active new customers in the first 8 weeks of 2025. Which is the same number that we actually added for the whole of Q2. So our growth in customer numbers is certainly accelerating, and I'll talk a bit more about that later in the presentation on some of the other slides. Our annualized revenue per user, or ARPU, is also moving in the right direction, up 8% on prior period to $74.29, and we'll also dig a little bit deeper in that as we go through the slides. To finish off this slide, an outstanding result of our FUM growth, which was up 32% in the past year. Yes, there was some positive markets there, but it's also some strong net flows, as you can see, with 106 million, or up 256% on the period. The net inflows of 106, which is when you break it down, it's really our customers putting money into their Raiz account, is up significantly from 30 million in the prior year up to 106. So it's not just that the market returns are lifting our fund, the customers are using it as we expect from our customers and what we continue to drive. And it's all about having engaged customers. As I move through to implementing our growth strategy on the next slide, if we dig a bit deeper on the business metrics from the previous slide, we can get a real sense of the specific activities that we're working on and pushing in the right direction. We've split this implementation into our 4 strategic pillars, which are shown in the slide later. But as you can see, we've made progress right across each one of those pillars. On brand and reputation, the first pillar, the biggest milestone achieved, as mentioned, was the strategic partnership with State Street Global Advisors, which will significantly expand our ecosystem and distribution channels. And we're pleased to also maintain the leading App Store ratings among our peers. Under the exceptional products, it's great to have external endorsement being the winner of the Finder Awards for Best Innovation, but also Super Ratings rated as the #1 non-performance for the 12 months for our moderately aggressive option. So it's always good to see recognition coming from those. In terms of our customer experience, the biggest change here is we've spent a lot of time, effort, and obviously money, as you can see through the cost base, on improving our marketing systems. And what does that actually mean? It means that we've moved to individually targeted market strategies. And this is what's making a real big difference to both our customer conversions, our customer retention, driving our growth in our active customers. We're absolutely delighted with a Net Promoter Score of 89% and our customer satisfaction of 93%, which tells us that our customers are happy and they want others to benefit from our fantastic products. Referrals are the single biggest source of new customers. So we're really focused on keeping our customer happy so they'll talk about us more and improve our numbers. Just to touch again on the strategic partner with State Street Global Advisors, it was a massive milestone in the first half, with State Street Global Advisors, the fourth largest asset manager worldwide. The background of this partnership is that we currently have about 450 million of FUM through the State Street ETFs on our platform. And what better way for State Street to show their commitment to the Australian market and partner with someone like Raiz. They don't want to adopt a direct-to-consumer strategy like some of their peers, and they understand what Raiz can do from a distribution point of view. So State Street came on board with 4.6% stake in Raiz in August 24, and we see this as a long-term relationship, and it's a win-win for both parties. From our perspective, we're looking for increased brand awareness and opportunities for joint marketing initiatives. We've also started to work together on new product development on some new ETFs, and in particularly the super retirement income product. We also get access to their extensive library of financial literacy, and that is one of the biggest pillars of our offering to our customers is the financial literacy and financial education, and State Street can deliver on this. We're also looking to create a Raiz sentiment index, which I'm happy to talk about later. So the key message here and the milestone that we've achieved with this partnership is that they're big. They choose us to work with, State Street have chosen to work with us, and there are a number of ways, some of them that we haven't even scratched the surface. On our customer-centric innovation, I'm sure a lot of people have already heard me say that we focus on customer-centric product innovation from day one, and that is the key, that is the secret sauce to our success. It is a core part of our operations and exactly what drives our value proposition for our customers. In the first half, we launched several new products, and moving from left to right quickly across the screen under the Raiz Invest, which I'm rather excited about, the recent release in January of Raiz Jars. This sits under the standard Raiz investment portfolio, and it's important because it enables customers to manage numerous investment goals within one account. The strategy here, or the thoughts behind this, is that our customers will build longer-term savings goals and approaches with us rather than a transactional experience where in the past they would set up a goal, they'd reach the goal and they would leave. Now they've got multiple goals on, and we're hoping that it'll help us retain and engage our customers for a period of time. With over 12,700 active jars in the last couple of weeks, it is very exciting, and I think the strategy will work. We're seeing customers say things like Brisbane 2032 or even Europe 2034, giving us the sense and the direction that they will stick around with us for 10 years to achieve these goals. But it's also too, there's some smaller goals or everyday goals, and people are even calling their jars for simple things such as a haircut. So we're getting great traction on that. Moving across, and why we won the Innovation Award last year was our Raiz Plus product, and we've increased that to up to 150 shares or ASX listed shares and quoted ETFs on the ASX, where customers can create their own portfolio. The FUM in that Plus portfolio was up 89% to nearly 250 million. Keeping in mind, we launched this product in August 2023. With that up, the Plus portfolios from a number of customers was also up over 50% over the last 12 months. Moving next, we also launched that Plus portfolio functionality into our super offering, which enables our super customers to personalise their own superannuation portfolios, which is huge. Again, we're really focused on expanding our super product, which is obviously a higher margin and long-term stickier savings. Super customers for the period were up 26%, and super FUM was up over 33% in the past year. We're happy with those numbers, but we know there is a huge growth potential in that segment of the market, particularly as we have that low-cost, high-performance product, and we are continuing to innovate with the likes of State Street in this area. So please watch this space for further innovation in our super product. And finally, on the right, our automated Raiz Rewards, which is now live with 57 merchants. Essentially, this means that when our customers shop at those merchants or partners of ours, they get instant cash back to their Raiz account. There's no login, they don't have to do it online. It is a very simple and seamless exercise, which means it is boosting the transaction volumes and also the rewards paid back to our customers. There was over $1.5 million reinvested on behalf of our customers into their portfolio accounts with our Raiz Reward products in the last calendar year. We're now also finalising a new look and feel of our Raiz Rewards in the coming weeks that will make it a lot cleaner and a lot easier to use, which we're quite excited based on the feedback of our customers. Expanding our ecosystem in new channels, I think it's important here, and we'll get into a few details here, but at the end of the day, working over the last 9 years of being live, it's not a product push for Raiz. We have tried and tested a lot of ways of advertising and trying to get our new customers, but what really works is using a distribution channel and strategic partnerships, and this slide sort of sums all that up. This time last year, we were also really focused on our contra advertising deal with Channel 7, who's a large shareholder. These contra credits have now expired in January, and we constantly do get asked from shareholders what's going to happen now that the access to the Channel 7 distribution network's not there, and this is the answer. This slide shows how hard we've been working over the past 12 months to diversify our distribution channels and expand our ecosystem of channels with influencers and alliances to help spread the word about Raiz and our fantastic product. We're really confident that we can continue to grow our active customers in a post-7 world, which we've shown to date, and we are working really hard in this space to customize our marketing and get the right message to the right customers at the right time, and that's what we're seeing in our growth. So going back to some of the numbers, and especially the business metrics, this slide drills into 2 of our core business metrics and shows that not only we are growing, but our growth rate has accelerated in the first half and is continuing into the second half, as shown by the orange bar graph. January is typically a strong month for new customer acquisitions, but in the first 2 months, as I said earlier, for the first 2 months of this quarter, we've added the same number of new net active customers to the whole of Q2 last year. We are pleased to see this trajectory continue, and we have the confidence in a stronger second half. On the FUM side, as previously mentioned, yes, the markets have helped us increase our FUM, but as you can see from the graphs, we've had some great growth, and the average account balance is now up over 5,000. But more importantly, it is that net inflows. Customers are using us with 106 million of net inflows in the period. An increase of 256% shows that we've got engagement, and engagement that we continually want. With a steady growth in ARPU, on the next slide, I just want to provide some more details, and this was a conversation and a question we've had with a lot of shareholders over the past 6 months, is to get the transparency and to understand what our ARPU and what the drivers of our ARPU are. You can see in the top graph that our ARPU has increased by CAGR or compound annual growth rate of over 9% over the last 4 years, and the bottom graph shows exactly what is driving this. The ARPU growth will either come from the account-based revenue in yellow, which this includes the monthly maintenance fees and account fees, which is the FUM-based fees. This reflects, you can see down there after the H1 23, that the graph, and we've clearly identified that the fee increase was there in August 23 when we released the Plus product. But it also shows that the customers are selecting these higher revenue products, such as Raiz Plus and Raiz Super, because there is, especially between Raiz Standard and Raiz Plus and some of the other portfolios, there is a dollar higher fee per month, and that will continue to drive as we drive our customers up that value curve. On the other source of the ARPU growth is from the transactional based, which is also shown on the graph as well in the green. The transactional based revenue includes things like advertising, which is sort of broken into advertising directly, but also the Raiz rewards and the clip that we take there, our netting profit, and also our interest. This revenue has increased through greater engagement, in particularly in our Raiz rewards programs, and that automated rewards that I spoke about is driving a lot of volume. We have higher trading volumes as well with the net inflows, and also which increases our netting revenue and also the associated interest income on those inflows. So transitioning to operating profitability, the result of these activities is the result of all of these activities, and particularly the work we've done in the marketing and the channels, drives our active customers, ARPU and FUM. This all leads us to increased revenue and a relatively stable cost base, and therefore our improved profitability. A few call-outs on this page. We have revenue up 14% and operating costs up 8% on prior comparison period, which gives us the significant improvement in the underlying EBITDA to just over 700,000, which is a comparison against last year's first half FY24, as shown on the graphs. If we look at the graphs on the right-hand side, we can also see the half-on-half comparisons, which shows and highlights this. Importantly, we've had 3 consecutive periods of positive underlying EBITDA. We've not reported this previously, and because the business was in transition. And what we're trying to do here is to sort of peel it all back to show that the elements of the discontinued operations of Southeast Asia, so that we get it. This is really our first attempt to get a clean set of accounts where we have gone back and adjusted those comparatives so that we can see apples on apples and see what the core underlying Australian business can deliver. Yes, we clearly make it clear that we increased our expenses over the first half for 25 over the first half of 24. But there was some material investments in both our new marketing systems, as mentioned. I mentioned these at the AGM. We've also improved and strengthened our bench strength for new hires in the team so that we can move a lot faster and a lot quicker on our product innovation. And there's been some one-off expenses related to external reviews of our technology, AI, and security. On the operating expenses in the coming half, we're expected to see this similar to the second half of FY24, which you can see is about $1 million lower than the first half. Just on capital management, I won't spend too much time on this because it is pretty self-explanatory, but you can see the free cash flow there that we've sort of highlighted, which is the operating cash flow net of the capitalised development costs, excluding the R&D credits and grants received back. In the interest of time and getting to questions, I'll move through that. So moving forward, it's been great. We've shared this presentation, or this slide here in particular, showing the pillars and our vision of an everyday focus at the AGM in last November. It confirms that our vision to enrich the financial well-being of all Australians is paying off. Every day, the team's focused on existing customers and attracting new customers. And we've got those 4 strategic pillars that can show us how, and as we bring those pillars to life, the second half focus of the FY25 initiatives are summarised below. But just to highlight a few of them, under the brand reputation, we've continued to developing some really interesting marketing strategies and first to market using both AI and our data. Under the exceptional products, as I mentioned, we're going to enhance our superannuation offering off the back of the members' feedback and also the development of the retirement income strategy in partnership with State Street. Under customer experience, our focus on the second half is about improving the UX and the UI, and that also includes improving the onboarding process that we can continually improve our conversion of customers into active paying customers. The relative size of the market, we've seen this slide before. As you can see on the left-hand side, a source of the ABS and ASX, we only have a slither of where we're going. We know what the market is, and I've made some comments in the past of what our target market can be, and there is still plenty left on the table for us. The key point here is to note that the addressable market is large, and we keep biting into those. There is no silver bullet that will get us to the numbers that we want to get to. It is small amounts add up over time as our fund, small channels, and doing what we're doing, continually doing for our customers is going to get us up that ladder. On the right-hand side, so the left-hand side shows us the new customer opportunities, but the right-hand side is still a massive focus and an opportunity for the Raiz business here. In the circles, you can see from the large one, we now have 325,000 active monthly paying customers. But you can see the size of the plus users pushing them up the value curve, the Raiz Rewards users pushing them up, and then the super users. And the super users, we haven't had the best cross-sell rate or the cross-promotional rate, but that is because of the product, and that's what we're addressing in this coming 6 months. So there is ample room for growth in both our market and our own customer. So there's sort of 2 channels there that we're focusing on. The competitive landscape, I get this question a lot, so we've kept this slide in there for this presentation. But Raiz does deliver a comprehensive offering for retail investors. This is the real value for money offering for a low-cost monthly fee to get access to our ETFs, to at least 100 ASX stocks, brokerage-free trading, using and leveraging the automated features of savings and rewards that we have, and setting up jars and kits. We think it is a very compelling offering for our retail investors, particularly first-time investors and the younger generation and demographics, and it's working. The competitive landscape, as we know, is changing. You would have all been familiar with the multiple bidders recently for self-wealth, and we just found out yesterday, I think it was, that the Bell Financial Group were not successful, and they're teaming up with the Financial Group from Singapore. But also late last year, there was the Spaceship and eToro tie-up. I've previously said, and I wouldn't be surprised if people are looking at us, because we have, as you can see from our numbers, we've turned the ship, we're heading in the right direction. But there's nothing to report at this stage, but I'll make sure I will if it comes to market. So compelling investment thesis, just to wrap it all up here, we're in a unique position of growth And you can see here from our 6 pillars here that we have a compelling investment theories. We always put our customers first, and we have a customer-centric culture driving everything that we do. Our NPS and our customer feedback shows that. Our retention and going deeper and having a stronger relationship with our customers show that. We have solid traction at the moment in the business, and we have expanded our ecosystem as partners to continue to drive the growth that we are seeing. We see multiple opportunities to accelerate through the upcoming launch of our white label solutions, and we've not even scratched the surface, as mentioned, with what we can do and what we are going to do with State Street. We have strengthened our position not only on the balance sheet, but also our board and our management team over the last 6 months. We have a model that is scalable, and it's proven to be scalable, and we're well positioned to execute on this growth strategy. With that, Mark, in the interest of time, I will pass it back to you.
Oh, excuse me. Thanks, Brendan. Yeah, we've got one in here. I think this is related to the Raiz jars new product launch. Is there demand for saving house deposits, and could you then get a brokerage free, for a mortgage provider at the end of that? So kind of, link up that whole value chain of save through Raiz. We have a partnership with whatever one of the mortgage aggregators or brokers, and you kind of use that as a distribution channel.
Absolutely. And anyone that knows the history, we had a Raiz home ownership product a few years ago, but it didn't work. But there is, and I'm a big fan, and Tim's a big fan of, you're only as good as your weakest link. So when we look at the jars and what people are calling it, it's absolutely, it's sobering to understand and see what everyday Australians are setting up and calling these jars. There would be a good 30 to 40% of them for home ownership or saving deposits for the house. There's travel. As I said, people are saving for Brisbane 2032. It's actually a massive opportunity to get better and more particular personal details on these customers. And then what we can do with that data is put the right product, i.e. if you're saving for a baby or a child, we can put our Raiz Rewards partners in front of them. And again, same with the brokerage, same with travel. Booking.com is one of our biggest partners. We know that someone's saving for a travel goal. When it gets closer or they're reaching their goal, we can serve them up a travel partner.
Another question here on the Southeast Asia business, or the wrap up there of wind down, whatever you want to call it. There's still cash costs coming through. How far away are you from being completely free of that in terms of wind downs and regulatory requirements?
Yeah, so we shouldn't see any more costs coming through the P&L for the second half. We've wrapped it all up. It is now all discontinued, and in the statement, so we can see that we've transferred about 600K. That was the Malaysian partner put in through their notes in the previous reporting period. That's now been transferred to the liquidator up in Malaysia, and as you can see on the front cover of our 4D, we don't have any more percentage holding in those entities. So it's, as far as I'm concerned, it's all wrapped up.
Okay, perfect. And then another question from me, with the State Street deal and the new products that you're going to be collabing on them, is there a part of the deal that says that you must use them exclusively for ETF products, or if Vanguard or Beta Shares come to you and they want to collab on some kind of products, that is still open, or does the State Street deal kind of restrict the ETF providers that you can work with on a go forward basis?
No, look, we've had a long-standing relationship with a lot of the providers, and State Street probably from the beginning, because they were in our core portfolios 9 years ago when we launched. There is no exclusivity with them. They respect what we do, and I respect their decisions and what they do, that they know that they won't have the best ETF for an exposure that our customers will like. So they completely accept, and I respect them and they respect our offering. So there's no exclusivity there.
Okay, perfect. And then another one on the automated rewards. I think you said on the slide, I think there was 57 of them up and running on the automated basis. From previous presentations, there's a much wider rewards partnership base there. should we expect to see that automated go up over time, or have you kind of reached out to all of them and the others are happy to stay with the status quo where people kind of have to go through the effort of claiming it as opposed to getting it automatically, or where are you in that process?
Yeah, I'll give you the 10-second difference between what we call online rewards, where you'd be in the app, you'd see, I'll take Adidas as an example, you'd hit the logo, it would take you to the Adidas website and away you go. And we track that, and that's how you get your reward. So that's what we call an online reward. The automated reward, because we have your transactional data for the roundup purpose. So Brendan's been into Adidas. It's on my bank statement. It'll come through Raiz. Then we can automatically pay a reward based on that. So it's getting the relationship with the merchants to understand how that works. And that's why we have over 1,000 partners on the online product, because you can track it through their website. There's only 57 on the automated rewards. So that's what we're working on, because what the whole idea of our Raiz Rewards program is that you're going to spend the money anyway. You might as well spend it with one of our partners, because that it might be only a small amount, but as I said, $1.5 million was reinvested into Raiz customers' accounts last calendar year, as Adidas has invested in you, Woolworths has invested in you. We want that automated rewards program to really smash it out and pump the number of merchants there.
Yep. Okay, perfect. Brendan, we're bang on time. Thank you very much for joining us this morning. And yeah, hopefully we'll touch base with you later in the year.
Absolutely. If there is any questions, you can go onto our Investor Hub and pop a question up there. Because if you do have a question, others might want to see the answer, and we can publish it on our Investor website, Investor Hub.
Okay, perfect. Or yeah, reach out to Katie either is another option there. Okay, Brendan, if I could ask you to please stop sharing your screen, and we're going to come to our final presenter for today's webinar. I'm delighted to be welcoming Tom Culver from Pharmx Technologies. Tom, if you want to just start sharing your screen, I'll let you know when I can see it coming through. It's just loading now, Tom. Click that permission, and then I'm not sure where you've got your deck. There we go, PowerPoint. Yep, that looks good, Tom. You can take it away when you're ready.
Okay, thanks, Mark. Good afternoon, everyone. My apologies, still getting through the technicals. Here we go. My name is Tom Culver. I'm the Chief Executive Officer of Pharmx. So today I'm going to give you an overview of our performance in H1, an overview of the business for those of you who are new to Pharmx, as well as get into some details around our metrics and our financials. And lastly, just take a deeper dive into some of the initiatives that we've worked throughout the half. Obviously, we'll save some time for questions at the end, so please feel free to add them to the chat as we go. So looking at Pharmx over the half, performance has been strong. Our year-on-year performance remains strong, with uplifts in revenue and activity across all of our key metrics, some of which we'll cover later on in the presentation. You'll note throughout the presentation that as a result of investment in people and technology, this has led to an increase in our operating costs. We think these are necessary investments that is driving to strong performance. Internally, all our key initiatives are on plan, including some of the items that we'll work through in this presentation around our brand launch, our analytics platform, and some further development plans. We recently signed a commercial agreement with a New Zealand-based group called Tonic. This is allowing us to expand our market coverage to now reach 99% of all pharmacies across the Australia-New Zealand region. Currently, we operate with 99% of the Australian markets. The Tonic expansion with another partnership we already hold in New Zealand now gives us full access to that market as well. So it's a significant step for us as a business. We've also completed the early termination of a revenue share agreement with a group called Alchemy, and this completes the final acquisition of the Pharmx intellectual property. So those of you new to our business, Pharmx is a marketplace proposition that we run. It's an ancillary business that sits beside our gateway, which is our core proposition. And since myself joining the business around 18 months ago, we've gradually brought the ownership of Pharmx in-house, initially starting with development and now severing all ties with the original founding party. As a result of this early termination, the board has now endorsed a program of work that's going to enable us to enhance the marketplace services, and this will result in Pharmx operating under a single platform, under a single brand. Again, we'll talk about this a little bit more throughout the presentation. Looking at our financial updates, as I mentioned, performance has been strong. Revenues are up 17%. Our gateway revenues, so our core business, up 12%. And our marketplace up tenfold increase on comparable period. Similarly, our costs, although have risen a little, remain steady and well controlled, and we maintain a strong cash balance as at 31 December of 4.5 mil. So who is Pharmx? Pharmx is ANZ's largest pharmacy network. And ultimately, we sit in the center of the industry and deliver critical infrastructure that supports the entire pharmacy industry and their supply chain. So supporting order, delivery, and supply between key parties. We're the most reliable integrated ordering network used by 99% of pharmacies, responsible for over 20 billion in order flow. We connect all major wholesalers, suppliers, and provide a seamless level of access to over 80,000 individual SKUs. We partner with all the major point of sale vendors, technology providers, and multiple other ordering intermediaries. And importantly, we also collaborate with key government agencies, such as the NDSS, which manages the National Diabetes Service. Through this position in market, we maintain a dominant position across the industry. 99% of pharmacies today see the Pharmx offering as high quality, with 76% rating, and these are very good or excellent. We've got excellent brand awareness across the industry, with 93% of Australian pharmacies aware of Pharmx, and 80% of those identify our key capabilities around integration as a critical point of difference. Similarly, we have gone to this market to research and work through our growth opportunities within the business, and they have landed very, very well. 85% of the market confirm a strong appeal to our plans, which we'll talk through a little bit later. And this is being driven by the fact that 70% of pharmacies today want to change how they order. And so this presents a clear market opportunity with significant potential that can be leveraged through the execution of our targeted product focus strategy. We're also supported by some very favorable market conditions. Now, while some of these statistics are not the nicest statistics, they're important for our industry. So as we look at growing population and shifting demographics, we do have a growing population in Australia, forecasted to be around 33 million by 2041. As this population grows, it also gets older. And so those over the age of 85 is looking to increase significantly also by 2041. And similarly today, as we look at now, over 80% of Australians have at least one long-term health condition. So if you think about the factors of what drives consumers to see a pharmacist, these are critical areas that point to a strong future market state. Now, these are also supported today by a change in the scope of practice with a pharmacy. So for those of you who understand and know about pharmacy, you may have, more recently gone to a pharmacist, and now you can understand that you can get a vaccine, you can do a sleep apnea test, you can have consultations around weight control, as an example. So pharmacy is no longer just about prescription medication and over-the-counter service. There is an expansion of those services, which is bringing a new customer and a new cohort into the pharmacy today. Now, that is leading to a shift in what a pharmacy's role is in the community. Again, moving away from this traditional service around providing prescriptions, but operating much more as a retail store and taking a stronger position within the local community around healthcare and delivery of goods and services. Some of this is also being driven by new regulations. So we've seen a change in legislation around vaping, which means that pharmacies are now the only regulated body in this country that can sell nicotine-based vapes. And then as we think about the changing trends in retail conditions within pharmacy, there's a lot of competition being driven, a lot of shift being driven by the likes of Chemist Warehouse and say Priceline, which is really focusing the pharmacy as a retail orientated business as much as a care orientated business. Now, if we consider some of the factors around the consumers going to pharmacies, such as wellness, Australians are now in the top 10 spenders of wellness in the world, spending on average over $5,000 per year. Increasingly, this is being spent in pharmacies, being captured in some of those other driving factors. And then lastly, what is supporting some of these changes and relevance to our business is that, as with a lot of other industries, we are now seeing an increase in digitization and shifting expectations around what technology can do across the supply chain. And this is around efficiency to drive greater efficiency in supply chain, optimization, predictability, automation of management and real-time tracking, tech-enabled workforces to give people on the ground more time to work with their pharmacists and provide care, and updated systems across the board. So we wrap all of these up into our competitive advantages, again, considering the position that we play in the industry. So ultimately, we're industry's first choice. We've been around providing the service for 18 years. We've got a very high brand awareness, and we also have the largest network available, working with all pharmacies, all major suppliers, as I've mentioned. We've got advanced, very well tested, very well understood technology that's modern, it's cloud-based architecture, it delivers high availability, stable and secure services and systems to the industry. We have extensive analytics and data, visibility across the entire industry at a level that nobody else has access to. That gives us breadth and historical, so longitudinal data, which allows us to work with our partners to improve their businesses. We also have the most products in one place. And as I've mentioned, we have strong digitization and consumer trends as strong drivers of the business going forward. So what does this all mean in terms of the market that we're operating in and what our potential is for future growth? So despite the fact that our business, and particularly our core business around the gateway, has been a market for 18 years, and we work with 99% of pharmacies, we still see there's a huge opportunity for growth within that business and across the rest of the business. So our growth is focused around increasing the number of suppliers that operate across our platform. That leads to an increase in the number of suppliers that each pharmacy is working with and ordering through, which has a direct line into our revenue. So as we look at our gateway opportunity, again, there's potential for significant uplift in revenues from where we are today at around $7 million a year in total revenue, up to around 18 million from a obtainable market perspective, purely on that gateway product. We also operate a marketplace. Now, this is a fairly nascent piece of technology. As I mentioned, there's been a recent ending of the relationship with Alchemy, which now really allows us to control our future. We see significant opportunity in this marketplace, even with working within a small cohort within the industry. And similarly, around our analytics platform, our ability to grow analytics, help our businesses grow and get better, and in return, generate additional revenues for us. Worth noting that on this slide, all of these estimations are centered around our core business today. It doesn't consider some of our future plans around internationalization, horizontal or vertical integration, or other initiatives that we are currently working on as part of our BAU, which will also look to uplift revenue. As we think about what we're doing in 2025, our FY strategy has been centered on developing solutions that increase the number of suppliers across the network. This in turn drives engagement from pharmacies, it increases volumes and enhances our analytics capability and expands our addressable market. So we do this through simple activities around direct sales, through more complicated and modern activities around brand enhancement and digitization and targeted marketing efforts. And all of these are underpinned by an evolving state in our business around talent and technology, making us a more efficient business with a higher ceiling for scale. So let's turn our attention now to some of the performance throughout the half. Our platform performance remains strong with uplifts in revenue, as I've mentioned, and we've seen this revenue come across all the key activities within our business. So as we look at our supplier and account growth, as I mentioned, our FY25 focuses on increasing the number of suppliers we operate with, which in turn increases the number of accounts that actively trade through our platforms. So I'm pleased to say that we have increases of 10% in total suppliers, leading to an increase of 4% and 6% across our gateway and marketplace, respectively, in accounts. More importantly, though, what this has led to is an increase in volumes. So the number of orders that we see across our gateway platform is up 14%, whilst our invoice value is up 18%. This is representative of some of the tailwinds that I mentioned that are driving the industry, some of the competitive features that are driving the industry around diversification of suppliers and the number of orders that are being made. But interestingly as well, what this shows is that there is a very healthy industry underlying with an increase in order value. Similarly, as we look at our marketplace, order value is up 700%, number of orders up 200%, and pleasingly, our average order value is up 150%. Where do some of these trends come from? We see this across the board, but we do have some outliers which are of note. In particular, even prior to our signing of agreement with Tonic, and New Zealand invoice numbers are up by almost 30%. Vaping, which I mentioned, new legislation is increasing invoice values around 400%. We're seeing an uplift in medicinal cannabis around 20%. And then we focus increasingly on key areas around things like beauty, technology, etc., as being kind of key drivers into the pharmacy network. And taking a look at beauty with key suppliers, we're up almost 400%. So just taking a look at financials and a deeper look at our profit and loss. So as we've mentioned, revenue growth 17%, and this has been driven across our gateway and our marketplace platforms. We've maintained cost discipline, and we have had some planned investment in personnel, rebranding and marketing, enhancing our IT infrastructure that's supporting this growth. And as a result, amortization has increased as the software development continues across the product suites. The result of the early termination of the revenue share agreement with Alchemy has led to a reduction in the amount of payable under the agreement by around $825,000. A corresponding adjustment is made to the related intangible assets, and so the impacted both the current tax expenses and deferred tax for the half. Ultimately, what this has done by our business is that we have spent a little bit of money to sever the relationship to save us significant long-term outlays. As we look at cash flow, positive underlying cash flow across the business. These operating cash flows have been used to partially fund the ongoing investment in product development during the period. We have also received deferred consideration of 1.255 million from the sale of the pharmacy software business. This was received in H1. During the period, we've also finalized the long-running court case with Fred IT and made the final payment based on the appeal judgment. This has been well talked about in previous releases, and this is really the end of that case and that ongoing piece with Fred. And ultimately, what that means is we're left with a closing cash balance of around 4.5 million at 31 December. So a very healthy position. So we remain in a strong financial position, and we have capacity to invest in the business as to grow. So just looking at some of our initiatives for the half, I mentioned the relationship with Tonic and our strategic partnership. So Tonic is the dominant provider of both point of sale and dispense software in New Zealand. They operate with over 800 stores, and this arrangement plus another existing arrangement now gives us access to 99% coverage within New Zealand. That expands our total coverage to almost 7,000 pharmacies across the two regions, 99% of the two. What this opportunity allows is it allows us to not only access more pharmacies, but also increase our supply base significantly. Under this agreement, we will be looking to migrate the existing 50 suppliers that Tonic deals with onto our gateway platform, as well as bring in new suppliers that we already operate with in Australia or starting to onboard in New Zealand onto the gateway as well. And so this will take our direct supplier number to well over 200 suppliers in total, bringing our total supplier count up to close to 300. There are also other opportunities around data, marketplace, and potentially internationalization of our business through Clanwilliam, which is the European-based owner of Tonic. So this is a very, very strong partnership. We don't necessarily think we will see a significant revenue uplift in this financial year. It will take time to embed the relationship and start to migrate suppliers, for example, but this will have an impact ongoing that will be positive and we'll start to see next financial year. One of our key initiatives for the year was our branding, our rebranding. Now, typically people think of branding as kind of pretty colors and a nice new logo. That's obviously a part of it, but it's been a very, very important piece of positioning our business. So again, a little bit of history around Pharmx. So prior to Pharmx being a standalone business that we see today, it was part of a larger group called Quorum Health. About 18 months ago, the point of sale system that was owned by Quorum Health was sold. Quorum Health is now a standalone private business that runs point of sale operations, leaving Pharmx as a standalone listed technology company. So it was an opportunity through this transition to reposition our business within market and with our customers. And so this is what rebranding has done for us. It's about reinforcing that market leadership. It is about the strategic alignment and updating our positioning. And so this is around focusing on people being in safe hands with Pharmx. We've been around for 18 years. We have an excellent record and we have a very patient-centric approach. And we are there to align and support both our suppliers, our vendors, and our pharmacy customers, and ultimately those receiving care from pharmacists. It also supports our long-term business growth. A strong brand increases loyalty, it reduces churn, it increases efficiency of marketing and scale. And importantly, again, for us, it simplifies how we present our products in market. It makes it easier for customers to understand who we are and what we offer, helping them better engage with our business. We've also recently launched the Pharmx Analytics platform. This is AI-powered analytics. It is the deepest and most broad data set in ANZ. It is a modern AI-supported platform built to scale, and it has best-in-class security and privacy. This drives revenue and opportunities by improving the businesses of our customers, in particular focusing on suppliers today, optimizing their supply chain, helping them understand and better manage issues within their business so they can increase efficiency, increase sale. Similarly, with pharmacists, it is about helping them move into a new era of sales, particularly, as I've mentioned, the changing trends around what a pharmacist's role in the industry does, and helping the larger banner groups become more efficient as they supply and order through their pharmacy networks. We also have external customers, so customers external to the industry, such as insurance companies, universities, government agencies, as an example, all of which are driving new revenue into our business. Now, I mentioned there's an investment into single platform and enhanced e-commerce services within our business as a result of the Alchemy transition. So our single platform is essentially us bringing our services together under a single brand to create more value for our customers. So those suppliers, pharmacies, and vendors, but also importantly, to increase efficiency within our business. So this is a fully integrated, consolidated Pharmx platform that significantly improves customer experience, creates technology, growth, and resource efficiencies that help us scale into the much larger market opportunity that we presented earlier. Importantly as well, this reduces confusion of brands in market. I mentioned that we have a marketplace called Pharmxchange as well as a business called Pharmx. Bringing those two things together simplifies things. It delivers more strongly into that key benefit that pharmacists in particular identify around our business, which is integration and the services we can provide through integration. It reduces risk in our business and allows us to scale, as I mentioned. The first area that we're focusing on around our single platform is our enhanced supplier portal, which we hope to be live on the 10th of March. This will be a complete game changer within our industry. So despite us operating with 99% of the industry, despite us operating with all the major wholesalers and key suppliers in the market. To work with our business, it has been traditionally quite difficult. It could take up to 3 months to do a technology integration into our gateway, requiring the supplier to have capabilities for technology integration and the ability to invest time and effort into doing that integration. And that has traditionally limited the number of suppliers that we have been able to work with in the industry and the amount of diversification that we can provide to our pharmacists. With our new supply portal, we are completely upending this on our own, and a supplier will now be able to onboard, self-serve, and engage with our entire network in as little as a day. So a revolutionary step for our business. We're also upgrading tools to help suppliers manage and grow their business, including product catalog management, order fulfillment, all of the key areas that we know suppliers, particularly small self-managed suppliers, need to manage their business effectively across a large network. And this is ultimately designed to increase transaction volumes by introducing new suppliers to ANZ pharmacies through multiple payment options. And so just to close, year-on-year performance has been very strong. It remains strong, and we've seen uplifts in revenue and activity across our metrics. We continue to be the dominant provider, and our expansion with Tonic has cemented our position across the New Zealand region as well. We've got a strong strategic growth agenda supported by tailwinds, a strong forward-looking strategy, and we're a well-governed business with expert teams. We're delivering to all our initiatives and KPIs to plan. We have unrivaled insights with well-managed costs that's resulted in growth, and we've got a very, very strong balance sheet as we look at our business today, allowing us to invest for growth. So thank you, everyone. That's the end of the presentation. I'd love to hear any questions.
Thanks, Tom. And maybe I might just kick off with the first one. In terms of the analytics platform, is there plans to monetize it, given the breadth of the data that flows through your system, to pharma companies, to market research agencies, to government agencies, public health, that kind of thing? Or are you going to keep it as you set out kind of there in the presentation?
Yeah, so we essentially have 4 customers for analytics strategy as we think about it. We've got the supplier market, which is where we have started to work on. We have the pharmacy market, which we built in as part of our single platform as we develop that. We think of ourselves internally as a customer as well. This is about making our business more efficient and our platforms better, such as building recommendation engines, etc. And then there is that 4th customer, which I did mention in the presentation. So we see this as universities, insurance companies, government agencies, health agencies, etc., all of which we're already engaging with and starting to issue analytics to already. So the platform has only actually been live since the beginning of January. And to put this into perspective, we have a pipeline across those 2 core customers today, which is suppliers and then the kind of third-party external customer, a pipeline of around $2 million already through the analytics and the capabilities that we're able to display.
Okay, we've got a question here from the audience. Can the gateway platform revenue grow greater than inflation, or how do you think about growth in that core part of the business?
Yeah, so I mean, as you saw, our revenue was up 12% for the half. So, we're obviously growing more than inflation within that business, fairly significantly, and we expect that to continue. And that comes through activities that we drive in the business, in particular to increase the number of suppliers that a pharmacy works with. And that's a direct line to our revenue. So, for example, for every supplier that a pharmacy orders through in a particular month, we receive a fee from that supplier. We have different cohorts with different numbering of connections that range from an average of around 7 suppliers per pharmacy up to around 25 suppliers per pharmacy. Our opportunity is to increase the number of those connections, which increases our revenue opportunity. For us, that starts with increasing the number of suppliers that pharmacies can access.
Yeah. And that kind of goes into another question I had. If we take a kind of a standard Priceline or Chemist Warehouse pharmacy today, if you look across Gateway and Marketplace, how much of the total number of SKUs or revenue maybe is coming through that supplier base that you've already onboarded? Is it, 10% of the shop? Is it 20% of the shop? Or am I kind of thinking about it in the wrong way?
I don't think you're quite thinking about it in the right way. I mean, given the network and who we work with, you'd say that 90% of goods going through the shop comes through our network. So we
Okay.
work with all the wholesalers. So your Sigma, your Symbians, your CH2s, your APIs, for example. We work with all the major distributors and suppliers. So whether that be Reckitt or Blackmores or Haleon, as an example, all the way down into an individual supplier who might supply, I don't know, protein powders or other vitamins or other services. Or, for example, in most pharmacies, you'll see at the counter, there's sugarless sweets that sit on the front of the counter. All of that comes through our network. So it's the vast, vast majority of goods and services.
Yeah. And then in terms of the suppliers, you talked about the 50-year onboarding in New Zealand. How much, I guess, scope is there for getting suppliers in from New Zealand and Australia, where they're on one system, but they're not on the other system. You talked about the first 50, but is there many more, given that a lot of companies, Australia and New Zealand, they just operate across both markets pretty much simultaneously?
Yeah, so again, so a lot of products are very similar. So you would see, I don't know, a generics Panadol product will be the same product sold in Australia and sold in New Zealand, but that doesn't necessarily mean, for example, that provider distributes in both of those markets. They have the capability to, but they don't. So yes, there is the 50 that I highlighted. We have another set of suppliers that operate through one of our other key partners that we can now bring onto our gateway service. That's another 25 suppliers. And then we have a whole range of suppliers that operate in Australia but do not currently operate in New Zealand, who are very interested to do so. And what we allow those Australians, for example, to do is we allow them to do it very efficiently with a single connection. So what they've been hesitant to do is expand because it would be costly working with each individual store, growing store by store across a new market. It's now one integration point with us through to an entire distribution network. So the scope for greater suppliers and cross-pollination between the two markets is strong.
Yeah. And the analytics product, just a final question on that in terms of, is it SaaS-based license type product? Is it a, cost per report, cost per download? Maybe just talk to us about that and the kind of margins you're kind of targeting within that business.
Yeah, great question. Yes, it is essentially a SaaS-based model. And so we provide two options within that. So we provide a data as a service option, where essentially our customers white label our data platform and we provide additional analytics services as well as reports. And then the second model is we provide access to specific reporting based on their business needs. Each are essentially a monthly subscription to access under a SaaS model. That is the same for supplier and pharmacists. With pharmacists, what we intend to do as part of our single platform launch is actually create a free tier platform, which will be available for all pharmacists to help manage their business with opportunities to upgrade into paid data services where applicable. For the third-party customer, so for example, the insurance companies, government agencies, universities, etc., this is actually done on a feed basis. So what is the volume of data required, particularly for a very heavy research-orientated customer? What is the currentness of the data? Is it live? Is it 30 days old? Is it historical? Will come with different pricing. And so typically we price that on a scope of work and a needs basis.
Perfect. Tom, apologies, we've gone slightly over time, and I don't want to cause you to be late for your next engagement. So we'll leave it there. Thank you very much for coming in and joining us. It's been a while since Nick joined us. I think it was still called Quorum then, or maybe just in the brand changeover, name changeover. So it was good to get an update on the story.
Yeah, very different business. Thanks for having us back, Mark.
Yep, no problem. And we leave it there for today. Just to remind everyone, we've got two events happening next Thursday, Friday, 5 companies Thursday, 5 companies next Friday. And with that, I wish everybody a good weekend and speak to you next week. Thank you.